Hey everyone, I'm your lead educator here at Trading Club 7U. Today, we're going to take a closer look at an essential aspect of trading psychology: handling losses like a professional. This isn't just about avoiding losses or minimizing them, it's about understanding the emotional and psychological impact of losses in your trading decisions. You've probably heard of the term loss aversion, which refers to our natural tendency to prefer avoiding losses over acquiring gains. But this can lead to a flawed decision-making process in trading, causing even the most experienced traders to make rash choices based on their emotions. So, how can we overcome this tendency and handle losses in a more professional way? The key is risk management. Now, I know what you're thinking: risk management is about avoiding losses, right? Well, not exactly. It's about understanding the risks associated with any trade and having a plan in place to cope when those risks materialize into losses. Think of risk management like a safety net or a fire extinguisher. It's designed to catch you when you fall, so you can get back up stronger and wiser. Let's look at a practical example. Imagine you're trading a long position in a stock called ABC Inc., expecting it to rise. However, the market takes an unexpected turn, and you incur a 10 loss. A lot of traders, including beginners, might panic at this point and close the position hastily, hoping to minimize the loss. But here's the thing: a 10 loss doesn't necessarily mean ABC Inc. is a bad investment. It's essential to separate your emotions from your trading decisions and focus on sound logic. One of the most common mistakes beginners make is panic selling when faced with losses. They do this without considering the potential benefits of sticking to their strategy and waiting for better conditions to re-enter the trade. Professionals, on the other hand, know that losses are a natural part of trading. They view them as opportunities for growth, using them to refine their strategies and learn from them. So, instead of panicking and closing the position, a professional trader might ask themselves these questions: was the loss due to a genuine market event, or was it a result of my strategy being flawed? What can I learn from this loss, and how can I apply those lessons to future trades? To illustrate this concept, let's take a look at a recent trade you might have taken that didn't go as planned. Write down what happened, how you reacted, and how you could have handled it differently using risk management principles. This is a crucial step in developing a more rational approach to loss management. Now, let's move on to a practical exercise to help you develop this mindset. Take a simple moving average crossover strategy on a demo chart and simulate a series of trades. When you incur a loss, ask yourself if it's a genuine loss or an opportunity to adjust your strategy. Are you taking unnecessary risks, or is your strategy simply not aligned with the market's current conditions? This exercise will help you develop a more rational approach to loss management and prepare you for the inevitable losses that come with trading. Here's a practical example to illustrate this concept. Imagine you're trading a simple moving average crossover strategy, and you're expecting the market to cross over from a short to a long position. However, the market doesn't cooperate, and you incur a 20 loss. A beginner might panic and close the position, thinking they've made a bad trade. But a professional trader might ask themselves: was the loss due to a genuine market event, or was it a result of my strategy being flawed? What can I learn from this loss, and how can I apply those lessons to future trades? In this case, the professional trader might realize that their strategy wasn't aligned with the market's current conditions and decide to adjust their strategy to account for it. Recap: today we explored the concept of loss aversion and the importance of risk management in trading psychology. We discussed the importance of separating emotions from trading decisions and viewing losses as opportunities for growth. Remember, the key is not avoiding losses, but preparing for them and learning from them. Thanks for joining us on this lesson, everyone. If you found this helpful, Please hit that like button and subscribe to Trading Club 7U for the next lesson in our trading psychology module, where we'll explore another essential aspect of successful trading, the psychology of risk-taking. For your next homework exercise, I want you to write down a personal risk management plan for your trading activity. Think about the risks associated with each trade, how you'll manage them, and what strategies you'll use to cope when those risks materialize into losses. This will help you develop a more rational approach to trading and prepare you for the inevitable challenges that come with it. Some questions to consider when writing your risk management plan include: